So hello and welcome back to CMD Forex lesson. This is Forex lesson for beginners. This is episode 2. So if you are new to this, please watch episode 1 and then come back to episode 2. Please like and subscribe to this channel for more of this videos. So without further ado, let's zoom in and then let us have a brief look at the history of money, gold, and then forex. Now, our main focus is not on this, but I just thought it's twice that I think we could have idea of what money is, the history of money, because we are going to learn about money. So if you are going to know something about forex, you should have a history of it. Right? I won't concern myself too much with it. I just give a short one, and then I think with that we are good to go. So I'm going to read first, and then I'll just give you a summary. So we are looking at the history of money. So gold, right? Gold is money. So now the Bretton Woods system of monetary management established the rules for commercial relations among the United States, Canada, Western Europe, European countries, and Australian among 44 other countries after the 1944 Bretton Woods Agreement. Now, these Bretton Woods agreements in the olden days, like centuries ago, centuries ago, they were the system that had the mandate to provide monetary policies. Like we have now, we have the IMF, right? What it has. So we can say that the Bretton Woods is now the IMF or the central bank that the World Bank, the central bank that we know. So that is the idea. Don't think too much. Let's take it on the on that surface. So that is just think of that as the IMF, the World Bank, and that because they actually will transition into what the IMF. If you want to have a more look at that, you can Google that and then learn it. I don't want to we won't concern ourselves much with this. Now, Britain Woods Agreement aimed at creating regulated market with what a currency peg, right? We have what is called currency peg. Every currency that we know, pounds USD, is actually a currency peg. The combination of two types of currencies, two different types of currency together, to them to form what a currency peg is what is called a currency what peg. We peg them, pegging one currency against the other. So, for instance, if we have pounds, right? We have pounds, and then we have visited maybe the US, and we want to change into USA dollars. If you go to the Forex Bureau or whatever, so that is what we do, right? We peg one currency with the other. In fact, there are some rules that guide them in doing this. If you want to know more, you can read that, right? So that is it. Now, their function is to do that, regulate what the market. The Bretton Woods system was the first example of a fully negotiated monetary order intended to govern monetary relations among independent states. The Bretton Woods system required countries to guarantee convertibility of their currencies into US dollars within 1% of fixed parity rates, with the dollar convertible to gold bullion for foreign governments and central banks at 35 per troy ounce of what fine gold, right? So let me just give you a brief history of money again, because we are treating history of money. So if you remember, in the olden centuries ago, what we were actually doing was barter trading, right? Barter trading. So barter trading was we do not have any special medium, any particular kind of a medium that we can actually do. But if you have one product, if you want one commodity, you can actually exchange it for another thing. So let's say I have sugar, right? And I want oil. What do? I just go with my sugar to the person who has that oil, and then I exchange it for that. So it depends on the quantity that we actually agree on to do that. So there was no any regulations and all that, right? So this what I'm saying now is at the level of what the nation, just within the nation, right? So every country were doing this on their own, independently or whatever, right? So that is what I'm talking about, independent. The barter trade, I think, was within what a country, right? So it got to a time that there should be what an international market, because international market is where one country or one nation can actually what trade with what another what is it, another country. So there should be a medium, right? A standard way of what doing this transaction, right? And then that one also introduced us to what is called the gold. So gold was the most common and then the valuable commodity at that level. So bringing that to that level, equilibrium or that standard, they have to what peg any other currencies or any other form of medium that each country was actually using as their main thing, as their main currency. So they have to back it or maybe peg it to what the gold, so that it become a standard. So if you at the national level, if you have one product and you want to get to another thing or transact with another person, the gold was what the main medium that they were doing. So that this Britain Woods system had to bring this standard into what into play, right? So that was the main thing. This is a brief thing. I won't go deep. If I do that, I'll talk too much, and then the purpose of video will be lengthy. So that's the level. So they wanted what a medium, right? Because we know that money is any medium, right? You know, at your basic level in education, you know what is money. So that is it. We have to have a standard. So that standard is what we call the gold standard, right? Any other currency or any other form of thing that you think is your money, you have to what peg it with this, right? So the USA was there, right? The USA was the only nation that could print. Okay, let me take it from here. Now, the creation of Britain Woods resulted in countries pegging their currency to the USA dollar, right? Okay, so it started from them, from that level, the individual countries, their currencies, pegging them to the USA, right? First of all, that was the initial pegging. They pegged them to the what? To the USA dollar. Now, in turn, the dollar was pegged to the price of gold. Okay, good. The price of gold, and the USA became dominant in the world economy. Now, in fact, even within this place, there's some funny history concerning how USA became the dominant as in supplier of what gold. There's a story there, which is very lengthy, right? There's a story there that is very interesting. Maybe some other time we'll talk about it. How they came to have a huge possession of what gold, right? So now other currencies were what pegged to the dollar, and then the dollar in turn was also pegged to what the gold to give us that standard, right? Like SI unit, you know that to a standard that everyone will have to agree, will understand, so that there won't be any misunderstanding when it comes to a national transactions and all that, right? So that is it. Now, the USA was the only nation that could print the globally accepted currency, right? And countries had more flexibility than they did with the old gold standard. Now, when the dollar seized, there was another story also that came up, right? And I don't want to go at it. Now, when the dollar ceased to be pegged to the price of gold, right? You look at it, I think shortly, look at this. I think this one I caught that in this episode, right? I think I wrote it somewhere. So you look at that. So it got to a time that the dollar ceased to be pegged to the price of what? Gold, right? It became the monetary standard with other currencies, pegging their currencies to it. Now, the United States held 3/4 of the world's supply of gold. Like I said, there's a story to that, how they came to have that huge possession of that. No other currency had enough gold to back it as a replacement, right? So the dollar's value was one is what? Five what? 35 what? Dollars, right? So now of ounces of gold. Bretton Woods allowed the world to slowly transition from gold standard to what? The USA dollar standard, right? So that is it. So you bring $1, you get 35 ounces of what? Gold. So that is what it means. That is the ratio. $1 to get 35 ounces of what? Gold. So it means that $1 will what? In order for you to get $1, you bring what? 35 ounces of what? Gold. I haven't seen gold before, and I don't even know how gold is measured. I only know the unit, right? So I'm just going to stick to that. I want to be honest with that. I've not seen gold before. If the only time I've seen gold, it may be in the movies, right? I haven't physically seen gold before, right? So that is even though I live in the country with a much production of gold. I'm in Ghana, right? In the world's history, Ghana supply, in fact, produce a lot of what? Gold. Yet I've not even seen a gold before. It's funny. That was just by the way. Now, over time, the dollar became substitute for what? For gold, right? That means dollar became what? The dominant, leaving gold even behind. As a result, the value of the dollar began to increase relatively to other currencies. So that is it. Now, so this is just a graphical representation of whatever it is, right? The history of that. Nations attempted to revive gold standard after World War One. Gold standard was adopted by the USA in 1919, dropped in 1993, returned to 8 in 1934. During that year, the USA raised the dollar of gold from $20 to 35 ounces of gold. Wow. Now, what is the Britain system? Now, the Britain system, in fact, a stable and fixed but adjustable exchange rate regime. That's what they do. Their main purpose to work on what? Exchange what? Exchange rates, right? Every country or central bank of that country, they are in charge of what? Their monetary policies for that. Drawing the monetary policies for that country. So that is what they do, right? Now, allied countries to fix their exchange rates by trying their currencies to the US dollar, right? The US dollar, the US dollar to be linked to gold per ounce at $35. Currencies to be kept within 1% of the fixed rate. They have a rate. They have when it comes to exchange rate, they have a rate. The national the central bank for every nation have a way of dealing with that. We call it the monetary policies, right? So I'm not a governor. I'm not a person to know about these things. I just know from the books, right? So that's what they do. I don't know what they actually do, but what they do is what to take care of what monetary policies during that when the economy is overheated, right? When there's too much inflation, we have a way of bringing it down. And then when the economy is too weak, we have a way of what? Bringing it up. We will have a look at them as we are doing this episode, right? We call it expansionary monetary policy, and then we have contractory monetary policy. We have a look at them, right? So don't worry too much. Now, so we are now with what? The fiscal medium for the money, right? We have the gold, and we have whatever form of money or the currency that each country was using until they did the pegging, bringing into into being the Britain system to draw the monetary policies, right? So that is it. So now let's look at the history of what? Forex, right? So that's what we are saying is what the beginning of free floating system, a system whereby no one has what absolute control over the system, right? A decentralized one, which we call it technically as what? Over the what? Over the shelf. So OTC, over the shelf, where nobody is actually in charge, no system, no country is actually in charge of that. So the forex is what? Is independent on its own, right? So we have a look at that. Now, so fast forward, this is just a history, so I don't want it to get bored too long. Now, European countries were not happy with the dollar peg. Like I said, we have looked at how other currencies were pegged to what? The dollar, and then in turn to what? To the gold. Now, other European countries, in fact, European countries did not what? Were not happy with this peg. So in 1972, an attempt was made to get rid of the dollar, right? They wanted to overthrow it. That supremacy, monopoly of dollar in what? In the economy. At the economic level, they just wanted to what? Overthrow it. Now, the arrangements created by the Europeans, like the Bretton Woods Agreement, collapsed in 1973, and all this led to the transition to a free floating system, right? The agreement created by the Europeans, like the Bretton Woods Agreement, collapsed in 1973, and this led to the transition to a free floating system, right? Now, these people were actually in charge, right? They spearheaded these, and then that is called what? The Plaza Accord, the Plaza Accord, or whatever. Now, in 1980s, the dollar rose strongly. Exporters and exporters did not like it, right? Dollar was still becoming what? The monopoly, very, very, very strong. Even now, we see dollar still being in charge, whether you like it or not. That's what. But there are other arrangements still trying to overthrow it. If you look at what is called the BRICS, right? Right. If you're interested, you can go and look at it. BRICS. That's what BRICS is trying to do again. So in 1980s, the dollar rose strongly. Exporters did not like it, especially when the business, the people who were the business people, right? Exchanging, transporting or moving products from one side to another. That's the international dealings. That is what we are talking about. So in the early 1980s, the dollar rose strongly against the other major currencies, right? We rose strongly against it. It was hard for exporters and the subsequent USD balance of what payments. Now the US dollar weighed on a third world economies and led to what? Factory closures. In fact, this is still happening. If you are someone who follows economic news, you actually know what I'm talking about. But that is not the main focus here. USA is still doing that thing. Now the USA it weighed what on third world wait. The US dollar weighed on third world economies and led to factory closures. And I'm saying again that this is actually happening cautiously. It's actually happening. You may not be aware of it. It's happening in another fashion, in another way, right? Now, in the 1985, a secret meeting was held between representatives of the largest economies. But information about the meeting leaked to the media, which forced the countries to make a statement encouraging the strengthening of non-dollar currency, right? So the agenda was what? To bring in another form of currency for economic dealings, which is different from the dollar. You're fighting against the dollar, that's supremacy of the dollar. And then this Plaza Accord was the system behind it. So this event was called Plaza Accord, after which the dollar began to fall sharply. So lo and behold, they were actually what? Able to implement the system. And then the dollar started what? Falling strongly. Now, the Second World War broke up the countries of Europe. There was a Second World War, which broke up the countries of Europe, creating many economic problems for the region. So I think the countries are what? The economic, the European countries, I think there are about 44 of them. I'm not too sure, but I think that's what I think. Right? If you have the correct figure, you can give us in the comment section. Now, so the Second World War broke this system, which these countries, which actually implemented this system, they broke it, creating many economic problems for the region. Now, wanting to save the region, many treaties were concluded, many agreements and whatever. And but the most fruitful was 1932 treaty called what? The Maastricht Treaty, right? Good. So this was able to what came to be. That was successful. Now, the introduction of the euro has given European banks and businesses a clear benefit from eliminating what currency risk in an ever globalizing economy, right? So I think that is it. Now, let us move to what Forex actually. But whatever I do is still in what? The digital way, the digital what sense. So we are actually going to talk about what? The forex or the online, whatever, any crypto, any digital asset that you know. So in 1990s, the world began to develop rapidly. What used to require more time and human resources was now being done faster and cheaper thanks to the internet, right? So whatever transaction that was going on between two different countries or whatever, they were done what manually, whatever. So now we have to work find a way to make it convenient and cheaper, right? Available. And then I think that was the introduction of the online trading. Now, money began what? Money began to flow quickly from hand to hand between continents. Volumes grew rapidly. The fall of the Berlin Wall and the collapse of the Soviet Union made the world open. There was an opportunity to trade Asian currencies that were previously inaccessible to traders, right? So it means that trading or transactions were actually done between some countries, some specific countries, right? Because they were not what available. The access to them were not that much. Until what the Soviets world broke, and then we had access to what the internet, and then other currencies what could actually be traded. So like in your country, you have your money, and then you do the manual way, right? But in the international level, I am a Ghanaian, but I can still be what trading or transacting in other currencies, right? So that is it. Other countries have the access. There are some countries we call the developing what countries, and then we have the developed countries. So if you're a developed country, in fact, if you're a developing country, you will not have that access to what having dealings with the developed one, right? So this union, the advent of the internet gave us the access to doing things flexibly, conveniently, online. So that is the idea of that. Now, online trading has started to reach a new level. Liquidity has increased dramatically due to the congruence of markets. Liquidity, I will not talk about it now. It's just a matter of the huge sums of money, right? Let me just give you on that lighter note. The huge sums of money, the volumes of money being pumped into transactions. That is what we are talking about. With the congruence of markets coming up together, different countries bringing up money together, transacting, small money coming together to form huge money. So that is it. Now, spreads have decreased due to the competition of online brokers and new technology. We look at brokers later. There are people that give us the access, institutions that give us the access to actually trade the currencies with the international institutions, the big institutions, the financial institutions. These are called what the brokers, right? We also look at spread, right? The changes or the exchange rates for the currencies when you change one currency to another. So that is it. Now, the time has come when anyone could enter the forex market and try to make money. Now, the volume of funds in the market grew at an incredible rate. So the forex is actually a platform where different institutions, big institutions, in fact, countries and whatever, have their funds there transacting and actually making money, right? So with this huge volume, you can actually engage on these things, and then you can also profit from these transactions. You have a closer look at this. Let's take the education. Now, the future of the forex market. Now, the forex market is growing from year to year. Volumes are increasing. There are more and more opportunities. Trading is evolving, as is the currency, which has led to the creation of cryptocurrencies in the crypto market, the development of which is striking in its rapidity. Never in history has a person had such an opportunity to earn a lot of money sitting at home, right? So now, initially, like in fact, it's still it's in play. We have the traditional way of working where you have to move from your house and then move to the office, the location to actually do the work in order to get money, right? But this actually is also a profession that you can actually, some even call it the passive income, right? You can actually use it as a passive income. Actually do this. You can sit at home with the help or just with the acquisition of a PC, a phone, and access to the internet. You are good to go. You can actually make a fortune. So that's what we hear on the social media, making it very catchy, right? It's true. There's no two ways about that. You can actually be in your house and make it. So that is it. So this will be the end of this episode 2. Please like and subscribe to this channel, share, and then comment if anything you want us to address. Let us know, right? If there are things that you don't agree with us, let us know in the comments. But bear in mind, this is purely for beginners, so I'm not going to go deep. I'm taking it bit by bit. So please read through with what? With caution, with adept attention. So that is it. Thank you very much, and see you in the next episode. Bye.